Everyone. Again, I missed you last week, so it's just such a pleasure to be with you again because it is something I actually look forward to, and hopefully we can even do this more often. We have it on weekly, but maybe we even do a little more get together. So again, this is what I look forward to. It's almost becoming my family, so I really appreciate it, and also. The times that we're living, and it's not just about the economy and finances, just as a world, it is very interesting times, and that's the word I could use. I don't know, I don't want to use challenging, I don't want to use unusual, but it is interesting. So these are the things I think we will remember for a long time to come. And structurally, I think things have changed. It's not this is not something that I believe in 3 months or 6 months be forgotten, and I think it's going to affect generations to come. So we are in a very uh, evolutionary and revolutionary times. I'd like to start our session with this saying from the Oracle of Omaha, Warren Buffett. As he said, that the stock market is a device for transferring money from the impatient to the patient. And I think we can apply this all aspects of our lives. And same thing could be also in trading. And trading doesn't have to be, when you think about trading, you think of people who constantly working on microseconds and milliseconds and trying to make tons of money, and that's how it works. Well, it's not the way it is. It works on the patience and finding the right opportunities. And the reason, again, I'm pleased to have you with me, and my mission goes far beyond actually making money. I think it's all about having the mental, financial, emotional independence and capacity for us and our next generation. And that's my mission. My mission is, I'm hoping just a tiny bit of little education, but most likely application of our knowledge, because there's just so much information out there. If we can apply that, hopefully our world will be just tiny bit better. And if we can work on one person, one child, one adult at a time, and making ourselves to be confident in ourselves and knowing that we can make a difference, then hopefully that will become a bigger change. And I start with this, and most of you have known me for at least been with me last few months. You know what my philosophy is and what my mission is. But I want to kind of use an analogy of weight control. As you know, weight control is one of the largest, basically, industries. And when you look at the New Year resolutions, usually it's the number one between that and then the money. So, and then happiness and success and a job. But usually it's the health and weight control. And it's such a huge industry, and it's such a huge pressure on people, that I thought it's timely to kind of use our strategy to find out why weight control is such a huge industry. Because if things were working, we wouldn't really need to have this industry growing as much as it has. I'll give you one example. This is Medifast. And Medifast, I mean, look where it was. Granted, people are staying at home. Maybe they're more health conscious. But this is, I don't know if you're familiar with it. They send you these, the foods to home, usually it's like a few weeks at a time, I believe. And the stock has gone from $50 on March 20th. It's at $152. Now, the problem, I think, why we have such a huge industry in weight controlling and diet and with the pills and other things is because we look at things from the one prism. We look at things from one angle. We do not look at things that people, we are different. We're genetically different. Our biology is different. Our environment was different when we were born. Uh, as far as our mindset, emotional, it is education to understand how we can control our health and everything, but there's a lot of other factors goes into this. And the problem it starts with us in the sense that until we understand where we come from, we will always have these challenges. And I used weight because it is a very visible one. You talk to a lot of people, and I live in California, so obviously it is even more so. People are very much more appearance oriented, and obviously because of the climate, we are exposed a lot more than, let's say, Minnesota or Iceland. So what happens is we haven't really looked into the depth of the issues. And I want to use that to transfer to our investing. When we look at investing or trading or any type of money vehicles that we want to have education, we have become more of a information hawk. So what we do, and especially now, there's just so much information out there. I mean, what I'm doing, obviously, you have access to tons of educational programs for free for a fee on YouTube. There's just so much out there. The problem is this information doesn't become structured and doesn't become more of a pattern of learning. So what happens, we jump from one thing to another. And I've used this a lot in the past, that it is our self-awareness is our biggest teacher. Knowing who we are, where we're coming from, that's your best teacher. I cannot do that. I cannot, no person on Bloomberg, on CNBC, the Fed, none of them can do that. And I've used this example. I have mentioned about a very successful friend of mine who's a very famous trader, but in its own circuits, and he's brilliant. And he used to mentor a lot of people. And at the end, he just gave up and he said, Ramin, I cannot take my brain and my background and put it in their head. So it is about you. What I like to do is I'm hoping to give you some kind of applicable knowledge that you can use it. And basically, again, it comes from inside out rather than outside in. So what we want to do, we want to mix the knowledge that we've accomplished and learned, and look back and look at our background and say, where are we coming from? What habits that we've had? I'm a big advocate of, let's say, journals. Why do I say that? Because I want to see the trends in my mind. What kind of feelings I had when I was doing a trade or an investments. And I use this, I use my simple rules, so we can apply it in all kinds of aspects of our lives. But let's say I use it in investing or trading. First of all, I want to know why I want to take an action. What is it? So a simple thing is I look at the markets, I look at the different global forces, and I say, well, maybe this is the time, for instance, take an action and buy this or buy that. And when I know the why, then I have to know what action do I want to take. Do I want to be long? Do I want to be short? Am I talking about crude oil? Or am I talking about Aussie dollar? So then after I know what vehicle, what action I'm going to take, then I want to know how I'm going to approach this, what vehicle I'm going to use. Now I know based on all the analysis I did, I'm looking at the risk on and risk off. I just use that. I see, well, there's a harmony. The markets are going to go up. I see, all right, the stock market is going to go up. Now, what do I use? Do I use futures? Do I use options? Do I buy the stock indexes, ETFs? What vehicles do I use? And that's the how. And then after knowing all that, when do I get in and when do I get out? So what is my action time frame? And do I get in and hold it for 10 minutes? Do I get in and hold it for a day? So these all have to be clear. So once you have this clarity, I think it applies in a lot of different things, but I'm just focusing on trading. Then it becomes a lot easier to understand why you're even doing this. I did share this in end of March, beginning of April. So I thought it would be nice to revisit and again about the vision that I have for our group. The first thing is, again, you want to have a clear mission and vision of why you're investing and trading. It is so important. It should be written. Like anything else in your career, in your business, in relationships, in your parenting, you want to have that clarity. Once there's not clarity, regardless of how many uh, trading education you take, how many videos you watch, it's not going to happen because it will be a very short-term diet, basically. You might stick to it for 2 months, but after that, it's going to go away. But this, again, coming from within, it helps you a lot more to stick with your pattern. Even if you fail, you understand where the failures were. And obviously, it helps to know what your personality is. What are your biases? What kind of family you grew up? Was the money evil? Was being successful was a priority at any cost? So these are the things you have to analyze. Then you have to decide whether you are really a trader or an investor. And they're completely, I've mentioned before, there are two types of personalities, and you have to learn which one is which. Is this you're going to be a short term? Are you patient? Are you decisive? The decision that you make, are you comfortable to get in and get out? Or you like to be methodical? You want to analyze everything. And with the energy that you put in, then obviously you want to be more of a long term and be an investor. And then we talked about the vehicles. Now, do you want to be in stocks? Do you want to be in futures, options, Forex, real estate, bonds, Bitcoin? And these all go with the short term and long term and intermediate term. And that's where the education comes. You want to learn the mechanics of them, but everything comes from within. Then you know what your characters are. And I use, like, for instance, with options. I am methodical. I am, mathematical background. So I really enjoy the option sides or the futures. I like that understanding that I could be in more of a control than, let's say, when I invest in, let's say, even stocks. Stocks, the CEO could have does something wrong, have an affair, I don't know, and the CFO does something and they cook the book. So sometimes with that, you don't really have any control because the news could be event-driven. With options, at least I have more control. The futures, I have some kind of a control. With commodities, for instance, there is not a single company. There's a collective of the forces, macro forces. And the last but not least, I want to emphasize this is, please, especially if you're starting, do have a journal. It sounds like really a simple thing, but it gives you so much pattern and understanding of yourself. My apologies if I'm being repetitive, but I know there was a day, never forget, November 4th, it's like 2008, and I had almost about 5,000 trades I did. And I don't know why, I paid more in commissions than the money I made. It was not, after 3 or 4 losing trades, I should have gotten out, but it was a stressful time. And I never forget that day because I did something and I didn't lose a lot, but it was very stressful. If I would have known that, what I should have done was, again, I should have stopped, go out, play with my kids, rather than sticking with that trading pattern that I was doing. And I was jumping from one thing to another. It was not a fun day. All right. Now that I got it out of the way, let's discuss the economy, because that is what basically the news is. Obviously, we are living in 2 different worlds, with stock market, which is the stock market itself is a different world. And let's see if we can make a little sense of what the economy is doing. As you know, the employment numbers came out, and this week we had the unemployment numbers. Again, we haven't been together for 2 weeks. So last week when we had, the week before when we had the unemployment number came out, it looked better than it was expected. But you look around and something doesn't make sense. I mean, you look at the businesses, you look at the restaurants, you look at now they're closing the bars again. You talk to hairdressers, you look at the people who do massage therapy. I mean, anything, talk about hotels, talking about casinos, airline. So something is not right. So as always, I like this again as the First Trust Advisors and Department of Labor comes with these numbers. I really enjoy this because it gives me a little better picture of where we were. As you can see, we can with the I'd like to see what happened month over month and week over week, and we are in green, and it's for the right reasons, obviously, because we have come from really bad spot. But that doesn't mean we are in a good spot. Look at the hotel revenues per available room. We still at $44, which is 56% lower than what it was a year ago. With the TSA checkpoints, for instance, still down 72%. We are looking at as far as hotel occupancies. And we even put down the box office receipts is, I mean, 502,000 compared to 330 million. And then you bring the sports, the concerts, all that. So numbers are getting better, but we are not anywhere close to where we should be, and to justify the valuation, in my opinion, with stock markets. But let's see, there's this, again, euphoria, excitement about employment and what is happening. And that kind of got me going. When they talk about now, this is the Bureau of Labor Statistics, they come out and basically they're the ones who talk about employment. There's always this conspiracy theory. You know, they've never been right. So, but they haven't really changed either. I mean, they've been wrong for the last 10 years. So let's put it that way. So it's not like all of a sudden, you know, in the last 3 months, they decided to change the numbers. So they've been wrong all this time. It started in 2008 was the same thing, 10, 11, 12. I mean, they continued being wrong, but at least it's the same thing. The problem we have, and I think that's where the numbers kind of get mishmashed, is we've never had any environment that we have now. In 2001 recession, 2008, there was more certainty in a sense of knowing where we stood. If you were unemployed, you were unemployed. You were looking for a job. If you were a part-time worker, you knew where you stood. Today, really, there is no real definition of unemployed. So let me go a little further. Now, we have people who are temporarily furloughed. Now, because of the PPPO, they are at home. The employer said, well, you're temporary. But you know what? They don't even know if they're going back. So they are furloughed. So technically, they're employed. So they are not unemployed because their employer hasn't said, listen, you're not coming back. So we have that challenge. Then we have effectively furloughed, that these are the people that the employers said, you know what, you're not coming back, but they're on the payroll because the employer got let's say the PPPs or whatever. So technically they are employed because they're on the payroll, but they're not working. So that's another challenge. There are people who are still employed, but of course they're working fewer hours or they're making lower wages. So the numbers look good because they are technically working, but the income aspects of where they are is much less. Then we have the independent contractors. I mean, how do you define that? We never had that. I mean, I use like Uber drivers, right? So they weren't getting unemployment because they were Uber drivers or 1099s. So now they're trying to change that, but how do you define that? So as you can see, there's a lot of holes in the actually calculating the numbers. Now, on the other hand, there are people who can work, but they're really not looking for it because they're at limbo. They don't know they're going to be back to work. They're not. On the other hand, there are some people who are getting, again, their unemployment check. And because of the benefits they're receiving, they were really, sitting tight. Some of them, I mentioned before, about 30 to 40% of employment, they're making more money than they actually were making as when they were employed from unemployment. Now, the challenge is, as you know, end of July, uh, that ends, but they try to obviously extend that. But so this definition of unemployed becomes a mystery. Now, Jim Bianco has, he's an economist and he tweets, and I saw this and I thought that was really interesting, so I want to share that with you. And it says initial continuing claims are the basic program. The government has many more programs, of course, but he looks at it, says it's 32.9 million. They're receiving some type of unemployment benefit, and that's the numbers came out last week, which translates to 23.77% of the workforce. Now, there's something is, if you have 23.77% of your workforce receiving unemployment benefit, how could you have unemployment rate at 11.1? I mean, it could be a little higher, the other number could be lower, but there's a huge gap. There's about 12.6%. And this is just a graph to show you, I mean, here we are. I mean, this is where we were. This is the unemployment. And then here we are as far as the M3, it shows 11.3, but we have 23.3%. I also did a little, Indeed, which is they analyze temporary and job applications and things. So this was interesting to see. Some of the sectors are obviously got hit harder, and some of them not as bad. So when it's interesting, you look at the retail, but again, this includes a lot of online, and then you look at it in the Home Depots of the world, and Lowe's, and but also Amazon, and a lot of things. So they have come. I mean, they have been going up since May 1st. Driving, because a lot of people are ordering pizzas. There's a lot of other things that need drivers, so that hasn't been hit hard. Loading and stocking. Now, as you know, it's a lot of retailers, they say, well, come and pick it up. So there's a lot of inventories are moving from one place to another. And it's interesting, beauty and wellness, people being at home, basically it seems like we are becoming more health conscious. So, I can't go to the beauty shop, I cannot go have a haircut or color my hair, for instance. So now I'm ordering things at home, I'm trying to do it myself. So basically that's where the reason they haven't been hit hard as much, and that's what stocks like Ulta has done well. Then we have some that they have about average economy, the food preparation, nursing, customer service, software development, believe it or not, they got really hit hard because of the demand. And they're coming back up a little bit, but so they were more of what the economy did. This is where the hardest hits. I mean, this is understandable. Childcare, they don't want to leave anywhere because they weren't going to work, number one. The arts and entertainment, we talked about concerts and sports arenas, and obviously the hardest hit is the hospitality and tourism. We are open a little bit, but with the second wave, we don't know what's going to happen. So these numbers are as of July 3rd, but I think they might be changed downward. Interesting things is the banking and finance. I mean, it was shocking to see there's about 46%. As you know, last week, Wells Fargo came and they're going to try to lay off close to 1,000 or more. And the concern is, I think the banking area is the fear of the mortgage defaults, and obviously with the renters. And what's going to happen, this is a little prediction I make because of, the banks are going to start with their earnings, which we'll talk a little later. with their earnings coming up in next week starting. What will happen is, I think they're going to really throw a lot of bad news out there saying that about mortgage defaults. But most likely it could be like the markets might take it to positive because they say, well, now the banks are really going to cover themselves with the higher capital requirements. So it's going to be like a bad news is going to be good news. But there are going to be a wave of, especially in the commercial end. So, but this was really interesting for me to see even if you go around, you see that quite a few branches are not open. They're minimizing the number of branches for as far as doing your banking. Well, we use like this the word of the day. A few weeks ago, we talked about emerging markets and investing internationally. Like anything else, is the money flows, and the money is the king in a sense. So I mentioned in fund management, money is like a river. Money goes to find where is the best opportunity. So like a river, it moves. And that's why the money goes in and out of different markets. And at this time, one of the reasons you can see that like the stock market has gone up, and a few companies are the ones who are really absorbing all that money, is because that's where the best opportunity is. There is no yield. That we have negative or 0% yield. The money cannot find, and that's what is concentrated in a few names. And the foreign direct investment is basically, in a nutshell, where the money goes from one economy, and it's like comes at the inflows, let's say in an emerging country. When the inflow is coming from the foreign investment, it could be any type of a non-resident investment arena, then that becomes we call it the inflows or the foreign direct investment. So when you want to analyze a country or economy, you see how much of the inflow is coming, because that money comes in, and that's what basically it revamps the economy in that country and helps to grow. The opposite is the outflow. So when there's a fear, when the hedge fund is worried about an economy, and we saw that in Asian contagion in 1997, 1998, we saw in the Russian debacle. So when the money flees, then it goes all at once. The neighborhood, all money goes, and it takes a long time to come back till there's a stability. So UN last month did a study, and they looked at where we've been from developed economies. The majority of the inflows are 802 billion. Then we'd be looking at Asia. That was about 30% of the world's the inflows. And then the transition economy is more of a frontier, more of a emerging, pre-emerging countries. And then we look at Latin America. So I'll let you study it because you'll have the slides, but as you can see, it's been pretty healthy 2019, especially the transition or the frontier markets, they did pretty well. The question is this. This is what worries UN, and looks at about drop of -40 to -30%. So basically that's what they are concerned about, and how the economic growth, how the supply chain is going to happen with this. So this is a food for thought. Again, don't want to be negative, but I want to be realistic. So I'm always prepared. I look for the opportunities, but these are the things you have to look for, analyze, and say, this is where I can see opportunity, and this is where I see the challenges. And whether these challenges can be resolved just by printing money or with the central bankers' actions. The markets. Last week was okay week when we look at the weekly. And basically, again, we have a tale of two markets in a sense. The Dow Jones being really the weaker part of the weaker sister of indexes, because year to date is still down 8.6%. although for a weekly was 0.96% was up. S&P 500, which I would say is something between NASDAQ and Dow Jones, because it has some common components, and they were up 1.76. And this is becoming an old story now. The NASDAQ composite was up 4%. And it is just actually done, that means up 18%. Who would have thought? This is year to date. And we've mentioned it before. Obviously, the main reason is the components of it. When you look at Apple's, and you look at Amazon, and you look at Alphabet or Google, you look at Facebook, Netflix, now Tesla is becoming a bigger component of NASDAQ. And also with S&P having those components. So that kind of explains why we have these growths. I mean, S&P is almost getting to the flat for the year to date. And I've mentioned before, these two indexes are market cap oriented indexes. So the larger the companies, the more effect they have. And at the end, I will show you where the market caps of the large companies are. And you can see again, this kind of maybe hopefully it gives you the clarity why, for instance, NASDAQ is up 18%, why S&P is up only negative 1%, but yet Dow Jones is down 8%, or Dow 400 is down 8%. And we go more in details about what is happening to small caps, for instance. So in decisions is a little more details what all the investments did. I mean, the transportation, for instance, was up about 0.83%. Russell was up about 0.64%, which is the small caps. So, and I look at the advanced declining, and you can see last week we were pretty even. This week we were more positive. I mean, this last week was pretty even. The week before we were more positive, especially after the Friday's unemployment numbers when they came. But it's not just about the money, and it's about the complacency. And I look at something called put-call ratio. I don't have it here, but there's a lot of complacency in the put-call ratio. And I also something called a skew, which is we call it the tail end of the risk, which is the left side. That's when a lot of hedge fund managers start really buying put options, and they put a lot more premium on it. And what happens when the skew goes over 1.35 and gets closer to 1.5, that's a warning sign. The same thing with here, the markets, and this is from the Citigroup. We still have a little complacency, not a little, but there is complacency, and we've been there since, believe it or not, since May. Obviously, the markets have been going up, but do these indexes justify exactly what is happening under the hood, what is really happening? This is the chart of S&P 500, and I go back from June, and as you can see, again, last week was an okay week. The week before we went and we hit that 20-day moving average, which you're gonna hear me a lot. And again, my whole goal is, and I mentioned, again, I'm hoping you become an independent thinkers. You do all the things that I'm discussing with you. You become confident enough that you can, on Sundays, you sit down and analyze it. And one of the strategies we use in the past, the power of the 20-day or the 20 moving average, or 21 days, depending on what you use, both are similar, and then the 200-day. But in this case, I just want to see where we stand with the 20-day moving average. But also, you can see it is really range bound. We did have, I call this an island. You see we gapped up, we gapped down. We went to the bottom of that channel, and that's where we've been really floating. So it goes back where we were here, and we discussed this from April to towards end of middle of May, and we were thinking that, you know, this 200-day moving average is going to be a huge resistance, but we broke through it because there was so much energy being coiled. The same thing is happening here, and we are really being range bound. We don't know which way it will go, but right now, with the earning coming up next week, starting for the few weeks, which I don't know how much of effect that's going to be, because I still think markets are still looking at the whole economy as a whole, and the actions of the Fed and the fiscal actions still going to be more powerful than just the individual companies. So, but it is a consideration, but we are, again, going back to another channel. So we move from this channel, this is where we are. So this, it gives you a little boundary and what's going to happen. Now, this is the under the hood. I mentioned, let's see what has happened. So indexes are doing well, but what is happening to the component of those indexes? And what I look at is, these are the S&P 500, so it's the 500 largest companies in the United States. 41.88% of them are above their 200-day moving average. What that translates was 59%, more than 59% of the companies. But the market has moved so much, and we are down only 1% for the year. There's not a lot of strength moving that market. So basically, strength is coming from a few companies. So that's how you can translate the health of the economy, and you can see this is one of the reasons that you don't see the parity. You don't see, okay, while I'm looking around, I see the weaknesses. I see, well, as people are not flying, they're not shopping much. So what is happening? Well, this is the reason. But yet, NASDAQ is up 18%. Speaking of NASDAQ, this is the QQQ, the ETF for the NASDAQ. And I mean, look at this chart. I mean, I don't even have to know anything about finances. And all I know, this is a beautiful chart. And as a chartist, if you use a technical analysis, you see that 20-day moving average. And I'm going to speak a lot more about this in the next few. I mean, you will see a common theme today. Look how beautifully it has stayed above this 20-day moving average. Now, if you recall, one of our strategies was when the markets move far or away from their 20-day moving average, they like to come back close to it. And I've called it the child-parent relationship, especially if you have younger children. Younger children sometimes move away, but they have to be close to their parents. So this is what has happened. You can just, I mean, every single time when it moved away, it came back and it kissed it. And as you can see, we kind of moved away. So there's a good chance that this is going to move up. The parents are going to go closer to the children, and the children are going to come back to close to the parents. So as long as we are above this 20-day moving channel, moving average, and as long as there's really no distribution in a sense of panic or anything, there's no reason to get out of the QQ at this time. Although, I mean, for any type of a fundamental analysis that we use, there's no justification for this. And I will show you some of the criteria that we use, but here we are. I mean, it's what it is. The money's going, and that's where it's happening. The money's in Apple and Amazon's and Tesla's and Netflix of the world. So that's one thing about QQ. But the rest of the story is with the financials. I mean, the S&P 500 has a lot of technology stocks now because of the power of the market cap. But until the financials move, that the economy's health is always in question. And this is what XLF has done. Now, which is the combination of 25, 26 stocks in the exchange traded fund of this fund, the 25 largest institutions. We are absolutely exactly where we were in the second week of April. So if you would have put money in financials and gone away and come back and said, oh my God, NASDAQ is flying and S&P has done well, your XLF will be breaking even. So until this moves, you still have questions about the health of the market. The second part of the market is the energy sector. Now, they had a wonderful move. They moved up, and the same story applies even more so than financial. As you can see, we really haven't moved much. I mean, again, now that's the reason you become more of a trader than investor in this case. So we broke above the 20-day, and then once we broke below the 20-day moving average, and now you can see the slope is going down, and now we just crossed the 50-day moving average. We've been under 200-day. We could not even get close to 200. We sold off. So basically, energy is just telling you that there's a lot of weakness. Now, in some technical analysis, they call this when the 20-day moving average goes under 50, that's called death cross, just because of, it's crossing, it's like a death. So you will, usually that's a negative. I've done some studies, sometimes it works, sometimes it doesn't. But in this case, because it's been so close, it gives you really heads up that there's a lot of distribution pressure. Now, let's put these two together. Let's put the financials and the energy and talk about Russell 2000. And why we do that is because Russell 2000 is the biggest components of Russell 2000 is the financials and energy, and the mid-size and mostly small cap. Obviously, this is a small cap. So a lot of, as you know, there's a big challenges with the small cap or small businesses and small companies. And what is happening, you can see there is no comparison between this and NASDAQ and also with S&P. While they're over their 200-day moving average, we only had 4 days and then we broke down. And since then, we have not been able to really move up. And the reason is, again, the main reason is the financial and the energy. When we talk about the strategies, this is where I'm gonna go elaborate a little more about the future. Now, on the other hand, every week we've looked at LQD, which is a ETF for the investment grade funds. And this is a good indication what the Fed is doing using BlackRock, part of it, PIMCO. And let's go back, this is when on Thursday they came and they said they're gonna start purchasing. So LQD leads the stock market. It started on going down, the same is going up, because it's the health of the investment grade bonds. Because if it's a triple B and up, if it goes below that double B, then the funds have to start selling. And that's where the domino effect happens. And that's the main reason, again, the Fed is adamant about keeping these investments investment grade. So if you have a borderline, they're pumping the money to save them. So as you can see, again, we are over 20-day moving average, and this money is coming. Really, it's not organically, it's just being fed. So fed by Fed. So anyway, so this is important to know. On top of that, now this is the story that if the markets are so healthy, if QQQ is going up or NASDAQ and then S&P is doing well, well, the bond markets shouldn't be as well, because that's a risk, in this case, risk on element of the investments, and yet they are comfortably above their 20-day and over their 50-day moving average. Granted, they went down a little bit on Friday, but they're nicely doing well. The money's still going to the bonds. So basically, there is a tale of, again, two stories. So the risk is off because money is going to stock market, but the risk on also doing well. The other part is the gold. If there's no concern with the stock market, the gold shouldn't be hitting where it was close to 2011. We are in 2011, that's the highest we've been since then. So we briefly went over 1800. We still comfortably up, and this is more of like an insurance hedge. So gold has become, again, attractive alternative for a lot of people. And I mentioned before, unfortunately, the gold dealers and precious metal dealers are taking advantage of investors' hunger for this insurance, and the premium spread has become pretty high. So I wouldn't buy, for instance, right now, gold bars. So But this gold ETF, it actually holds real gold. It's backed up by gold. It's not paper. That could be an alternative for you to invest. In the past, we've talked about gold investing. And the silver is a little sister of gold, and that's doing nicely. We see this looks like a saucer pattern, and we're nicely above the 20-day moving average. So maybe if you cannot, don't want to buy gold, maybe start doing some accumulation on silver, because that's, when you look at the ratio, it is in a pretty attractive spot. All of these also depend on, as you know, commodities very much related to the dollar. Now, the dollar had a nice run in the past month, but then because of what's happening with the rates and everything, we did have a sell-off, and that's the reason you can see the euro had appreciated, and a lot of people look at the emerging markets, basically because of emerging markets that are dollar dominated. Basically, dollar denominated, basically when the dollar goes down, obviously the value of debt goes down, so that's helpful for those economies, and you see how that has worked. And when the dollar goes down, frankly, commodity-oriented investments such as gold and silver appreciate. Copper. 2 weeks ago, I analyzed copper, and we talked about right around here, and I said, you know, it's comfortably above the 200-day moving average. And how could that be that economies, we talk about challenges for the economies, but copper is still doing very well. I mean, we've come, and I did an analogy of December 2008, when we get very aggressive in purchasing copper, because a lot of miners, they cannot stay in business, so they're not gonna, obviously because of the supply reasons, they're not gonna do it, because if the copper is really cheap. So it's more of a supply and demand issue. And then a lot of good news from China has been coming out, whether it's real or not, but that also is affecting, we call it Dr. Copper, which used to be a big proxy for the health of the global economy. But that could explain, again, there was really undervaluation on the price of copper, but also the movement in the Asian market, especially China. So talking about the risk on and risk off, now the VIX is, which is your volatility index. For the past years, you know, it's always been around 10, 11, 12. Anytime it went too close to 15, there was a little panic. And as you know, we went to a close to 85, which that was the top of the VIX volatility index when the markets completely dropped, and that March 23rd. The challenge that I have is with the markets being almost positive, we can see that VIX still close to 30. It is above the 200-day moving average. So there is a concern. And I look at the volatility of volatility, and I see, when I look at the futures market, I see they're purchasing, the managers, there's activities in those futures with a premium. So what this tells me is that there is a concern. And this is like almost like the insurance that they know we are not, you know, we cannot be complacent. So there is, as long as we're staying above 15, especially above 25, and last time we used Bollinger Bands, this time I haven't, but you can see every time we go close to the lower part of Bollinger Band, there is, we call it the managers come, the traders, they buy, put up, they actually sell the put options thinking that it's gonna come back up to collect the premium. So they're not letting this go down. So as long as the VIX is still above this, we have to have concerns about the markets. Last but not least, for you Bitcoin or digital currency investors, we have been very flat. We talked about halving in May. Since then, this really hasn't gone anywhere. So we are basically there's a lot of contractions right now, and I call it coiling. So there's a lot of energy again being coiled. So if it moves, it's gonna move quite a bit, just for your information. This is the vanguards, the emerging markets, and I mentioned about the dollar, and you can see there's a tale of two stories in the sense that they have done, again, above their 20-day moving average nicely. There's a big gap now, so basically they've moved fast, but because of the drop in dollar, they're doing very good. So basically they're back where they're up for the year, actually. I also thought, the semiconductors also have been a big part of the technology side of the investments. And so I got in about quite a few before that actually the drop. So this is what I got in. I still have quite a few shares, but it's the reason I want to show you this. It's been a nice move, but this 20-day moving average again, in this situation, as you can see, every time we got close to that 20-day moving average, we bounced back. We came close, we bounced up. We went too far away, we came back, we bounced up. This was on July 8th. I took a picture. And then this is the little line is a 3-day. The purple line is 8 days. So for trading, if you want to do the trading, I use a shorter moving averages. And this is a 21-day or 20-day. So basically, now we were up and we bounced on that 3 days. This is as a Friday. So we are a little away from the 20-day, but as long as you have that comfortably moving above that, you want to be okay with your longs. But once it breaks down, and it's my rule in moving average analysis, if I did, the fund managers use 50-day moving average. The traders, future traders use 18-day moving average. For investors, they use 20, or I use 21 days because of Fibonacci numbers. If the fund managers, when they use it, if there's a confirmation, if anytime we go below the moving average for 2 days or 2 bars, that's a confirmation. And that will be your selling, really kind of a guidance. Of course, you can use the indicators, but my goal is if I go 1 day and then the second day, especially if it's like a red candle or something, then that's distribution. And what happens, a lot of algos, so remember, there's a lot of program trading goes. So a lot of algos use the same program, and that's what you see the distributions happen. So for instance, this is what happened here. Again, this was, we call it the dead cross. So we closed once, and then after that, closed, there was a big gap. This was a warning right there, because the stochastics, we came from the, overbought, came down. We tried to go kiss the 21-day average. We got rejected, and this is what happened. All right. The last but not least, as far as these charts go, I want you to look at the DocuSign, which is one of our I call it the COVID stocks. Everybody's like, it's been fantastic to just sign everything online. The beauty of this chart is, again, I'm using the 20-day. I mean, how orderly is this? This is a beautiful chart. So basically, when you mention the moving averages contract, they come together like here. When they go away from each other, if it's the up movement, then that's bullish, and they open up, then it's almost you open your arms, and this is positive, you're loving, endearing, and this is what happens. It moves away. Now, in this case, you can see the 20-day has gone too far away from 200. So there should be some kind of a caution. You might be a little overbought. So watch this, because we want to be kind of wary of, we want to get back to that 20-day moving average. Now, what happens, that still doesn't mean that, you have to short it, buy like large put options, but maybe you can start thinking about, either covered calls or maybe do a spread, call spreads on these, because it looks like it's a little tired, but that doesn't mean it has to be sold. It just probably people will come and start buying, adding to their positions, or maybe use it buy on the dip. But we are, there's a big gap between the 20-day and 200-day. So this is a little about our strategies we used in the past. And also RSI is pretty overbought as far as MACD and stochastics. All right. Let's discuss the trade of the week. I had a few trades. I do a lot of futures, but I thought, and I love doing options. I do stocks, but more for day trading. But starting next week, what we will do is, because we're going to have our website, we will have our own, again, we'll have our YouTube, we will have videos on different strategies. So you can watch it at your leisure. Probably about 5-10-minute videos. We talk about different strategies as far as from the options to basically technical analysis, and we look at even from Forex. I mean, we go to a lot of different strategies and understanding the candlesticks and understanding moving averages and so on. So the trade of the week, I usually spend time more on the futures and options, but we will talk about stocks too in the future. So what I did, I've been looking at the restaurants, and Starbucks was one of them. And you look at Chipotle's and the CMG going to 12, 13. I mean, Domino's Pizza. You look at that end of the spectrum, which they're doing fantastic. People are enjoying eating at home. And then you have Starbucks, which because of the second wave, it's getting affected. So right around this time, I was looking at last week, I noticed, first of all, if you notice the 20-day moving average, first of all, we are under the 200-day moving average. So there is the warning sign right there. So this is not accumulation, it's more of a distribution. So as long as you're under 200-day, usually the fund managers or hedge fund managers, they usually use that as a criteria to sell calls, number one. And also they use it as a selling position to either get out of their positions or start shorting. So we go under 200, so there's that weakness. Then the 20-day crossed the 50-day, and we are actually under both of them. So last week when we went right here, remember I mentioned the 20-day, it becomes your support, your resistance. So the child goes, kisses the parent, had enough of the parent. Okay, bye dad, bye mom, I want to go again. It kisses and it wants to come down. We also have almost like a doji or a hanging man here. And you see that candlestick. So at that moment, I decided to actually go directional and start buying put options. No spread, just a pure put options. And it was for more of a short term because we did have, if you look at this, there's a lot of support at 72.5. So it was more of a short term. So remember, July 17th is option expiration. So basically, I decided to buy the July 17th at the money, the 75 Starbucks put option, about 10. So this is where I bought them. And the reason I want to show you this is you can see these came, it wasn't like I did a lot of technical analysis. What I do, as soon as I get in, and this is one thing, you want to make a habit of this, you have to have your targets set. It's, emergencies could happen. You can, things that the website goes on, your internet connection goes on. And also when you are putting your trade in, you're the most objective person at that time of yourself. Because you've done the studies, you know exactly what you're getting into. Remember, we talked about the why and the what, and now you did the when, you've done the how. So you know that, all right, this is my strategy. I'm going to get in. This is where I want to get out. No regrets. I know what I'm going to do. This is my stop loss. With options, I go pretty aggressive because with options, I know exactly my limit, my premium is, my stop loss. So I usually go 50%, depending on actually what options I use, but I'm pretty aggressive. So I'm pretty comfortable or confident when I buy the options. So These were my targets. I had already made my goals, what I was going to do, and that's what they get, just kept hitting them one after another. So within 2 days, this was the last one. I missed this ride. No regrets. I'm happy. It was okay. And then look what happened right after that. So I'm out. No worries. That was my strategy. It was a short term for a couple of days, and I'm happy with that. So that was the reason I got into options trading again, because of where it was. Um, as you can see, actually, we had this long tail. It told me that then the buyers are coming back. So this would have given you a little warning sign that, that there's going to be some accumulation after that. The second thing is I want to look a little more into Russell 2000. This is the Russell 2000 futures. Now, this is the weekly chart. Now, again, by looking at this, if you don't know anything about charts or anything, you can see this doesn't look very healthy. And the reason for being is this is your 200-day moving average. It has been rejected twice. And then I see these long tails. That tells me that every time the buyer's trying to push this, the sellers come into picture right around this area. For me, initially when I had done my analysis, was like 1460 was the area I wanted to go short. And you can see this is on a weekly basis. And then on a monthly basis, you see these are the Bollinger Bands. We went, hit the bottom, we bounced back to the 18-day, and then we are in the Bollinger Band is now narrowing, although we are over the 100-day moving average, but we are under 18. So there is a challenge there. So what I did, this was around here, because once we hit that the top of the Bollinger Band, I decided, it was at night, so that's another reason I want to talk to you. So I did a few of just a quick futures trades. Now, this is like around 9:30, 10 at night. So I did 5 or 6 or 8 trades. What is happening though is a lot of activities are happening overseas, or I mean after hours, mostly overseas. So that tells you these markets are very prime for movement, and that's what we will discuss. I've talked about gap plays, but I will do it in detail. We will have presentations on just how you can take advantage of the gap plays because of what's happening over after hours. While you're sleeping, what's going on overseas. ETF of the week. Every week I like to introduce you some type of a exchange traded fund. And this week I thought this was really interesting. It has a low volume. So the idea was not just about the volume, even though it's not a big deal with the ETFs, it's okay to have a low volume. But the idea of it, it's called empty. And what it is, it's actually this ETF goes look for in troubled mall retailers, which is brick and mortar. So let's say JCPenney's of the world and looks at Macy's. It predicts that they're gonna go bankrupt. So what basically it is, when they do badly, this ETF does well. So it's almost like an inverse. So it's sad, but that's how it is. It really works on the decline of the retail stock. So as you could see in March, when all this was happening, it was having a grand time because the retailers were, as you know, they got hit the hardest. So we had a little almost double top. So then in June, when everything started opening, the good news was coming in. So here when it started coming in, it went down, but then we had a little bounce because of against some of the retailers were doing better, they were opening, and then some of them were not. So I just thought this is interesting, just something. I mean, nowadays you find everything in exchange traded funds. I also want to go do a little journey, go back to the future as they call. I went back to one of our presentations in April 6th. And that was right after, about a couple of weeks after the whole thing, with the markets had happened. These were some ideas we came up with. We thought, with that kind of environment, what ETFs, we should consider. And at that time, again, we knew we were going to stay at home, and we were thinking, we are at Zoom on Zoom right now, so things like Zoom or Zscaler or Microsoft or Amazon, all the different things. And then we talk about the gamings. I mean, kids are going to be stuck at home, and what are they going to do? Of course, it's heaven for them being on their Xboxes and do the games. So we came up with some ideas, and I thought it would be interesting to look at them 3 months later and see how they have done. So one of them was the cloud, which is, again, the cloud computing, the companies that, you being home, that's, we were using a lot of those companies. Hero was basically the game companies from Take-Two to the GameStop, not the GameStop, but I can think of, but there's quite a few of the gaming technologies. Sensor was the Internet of the Things. AIQ was artificial intelligence. This WFH was supposed to come out in April. It just got delayed, and it stands for working from home. So there was a companies that you would do for working from home, again, combination of these. And then I thought PAVE would be interesting because of whatever administration will come, they have to look for, it goes back to almost like 1930s in a sense that they should be, in order to stimulate the economy and real economy, not just flooding the money with unemployment, the infrastructure would be perfect time to do that. And that's what the PAVE was. It's a machinery and other things that building it's a global infrastructure. So let's just review each one of them. This is cloud. So we suggested it right around here, and it has done pretty well. So, and still, again, I use that 20-day moving average. So as soon as it broke above this was your, basically your confirmation it's safe. And then once this 20-day crosses the 50-day, that's called golden cross. Golden cross is the opposite of death cross. That means it's crossing, it's really safe to go your second part of your investments to get in and stay. I mean, look how many times it kissed that 20-day moving average and bounced back. The hero is our gaming technologies and includes the Microsoft of the Wars 2 and the Take-Two, and I would, what company? EA, so that's the one. EA Sports, or EA is the other stock in this. And again, we recommended it here, right above the 20-day, and it has done okay. The sensor has done all right too. These are the Internet of the Things. AIQ as well. Again, you can see the repetition of this 20-day moving average. You kiss it, you don't stay below it for even a day. You cross it and you come back up. I want to show this AIQ again. Again, you can see how nicely it just stays above that 20-day. It's a little nicer presentation. And this is PAVE. PAVE, you can see, is a little more volatile. It hasn't done as well. We started here. There's just so much, again, there's a lot of politics. So this is, again, it's a consideration for maybe even after the election, regardless of what administration is going to come, they have to stimulate the economy. They have to do a real thing. And I think it's just a food for thought. Something like this is, again, the global infrastructure, something to just consider. I think a couple of weeks ago, we introduced the FANG ETF. It was right around here. I think it's like $90 or so. It hasn't been a bad couple of weeks. I mean, we're up about 50%, or actually more than that, in that, because it's a triple. So it just concentrated on the top 10. stocks, or only 10, the top 10 of the FANG stocks. So it wasn't a bad ETF to be in. This is that work from home. They just came in and they finally started trading, and it's done okay. With the opening of the economy, obviously it affects them. If we didn't have the second wave, things would have been a little different because people would be coming out. So this is another one I mentioned a few months ago. I mentioned I'm more optimistic about Asia, especially the Pacific Asia, and I think from the Taiwan to Korea and Vietnam, for instance, and Templeton Dragon Fund was a good fund. It's actually a closed-end fund, but we recommend it again around here, and it has done okay. As you can see, the gap up, and again the dollar being weak, regardless of what is happening with Hong Kong, and you see we still having a really nice move here. Another one was Hack, which is the antivirus. It was an interesting ETF, and as you can see, it has over 50%. So after those ETFs, so I mentioned about something really interesting is happening, and this might explain why you have the tale of two stories. We talked about Russell 2000 being affected, being weak, economic sensitive. The Dow Jones Industrial Average, the Dow Jones Transportation Average, they are weak. But then you look at the NASDAQ, part of the S&P, and you say, my God, what is happening? I mean, when you have Apple, which is over $1.66 trillion in market cap, it blows my mind. I mean, it's like some countries don't even have that value that the GDP is not even close to that. Microsoft is at 1.6, Amazon is at 1.5. Some of those we can say, well, I can understand, but Tesla is a number 19, and it has valuation of $265 billion. It went, maybe in October it was about 300. We're at $1,544. Now, you cannot use your logic in this. I mean, you gotta trade what you see. You got to, put the egos away. When this is what it is, this is what market sees. It's very hard to believe that Tesla is at 265 million and Toyota Motors, the largest, and Volkswagen, another one, is at 198 million. If you put Costco, Goldman Sachs, Caterpillar, and two other companies, I mean, if you put all of those, Tesla is bigger than those 5 companies put together. Forget about GM or Ford. Every single, I mean, if you put any domestic, auto makers here, they're larger. So this is the time to not start reasoning, but also understand what is happening. So you always, I've used this saying, you anticipate, you participate, but always be watchful, always be cautious. You always have a plan B and C and D. Know that, listen, I'm enjoying the ride, but I want to make sure I have my plans ready just in case there was something could happen. Again, the question is, what will happen with if there was the second wave got really worse, or what happens with the earnings, what happens with the unemployment numbers going, the unemployment checks stopping, and what will happen with the election. I mean, nobody's even talking about elections. So there's a lot of uncertainty. So, but enjoy this ride. But I thought this kind of might give you what is happening with the companies that 10 years ago you would have never even think about. They could be even close to where they are now. So I want to show you the chart of, again, this is where Tesla was in March. This is where Tesla is today. There's so many people shorting this, thinking that they are right, and every time Tesla is just burning them. I mean, look at what happened from 1st of July, broke 1,000 and we went to 1,500. But this is what it is. Again, we are a little too far away from the, so the 20 days trying to catch up. So the daddy is running after, or mom is running after the baby. So basically you can see that either this has to catch up, but then we are moving too far away from the 200 day. But this is what it is. So play accordingly, just be aware. And that's what I always like to take, a little bit of a profit at a time. And if I have 100 shares, well, I'll take 2 or 3 shares at a time. There's nothing wrong to have a little bit of cushion and cash. There's nothing wrong with, you know, sleeping a little bit at night. If that's the case, then so be it. With no commissions, I mean, before it used to be you got to call your broker and pay $50, $100 for 1 share or 100 share. Now you don't have that problem. So just be aware of that. Now, if you think this Tesla is, my God, you know, went from $400 to 1,500. I just want to share this. This is the Tehran Stock Exchange. And I've reviewed this once in a while with you. I did it in June. And beginning of the year, on January 1st, we were at 386,000. Remember, this is a market. It's not a one stock. It's a 365 stocks. This is an index. We went from 386,000. We're at 1,753,000. So you want to call it euphoria? I don't know. I mean, it was euphoria when it was at 600,000. It was a million. I remember 2 years in May of 2018. 2018, it was at 95,000. That index was at 95,000. Today is at 1.75. It's almost like a penny stock, which has gone IPO. And people are just like, this is Facebook. This is the actual index. So if you think there's some insanity going on, well, this is, you know, you can be the judge of. So, I mean, these are indexes around the world who have this behavior. Although, okay, the currency has depreciated, but that doesn't justify to have this. It's just there is no place that the money scares. I've talked to some actually, it's like we have few CFA charter holders there, and I've talked to them, their portfolio managers, they're all leaving that they're just doing stocks. There's just so much, people are just getting involved, and it's becoming almost like a tool of mania in a sense. But that's what's happening. So I just thought to share that with you. All right, we got a few more minutes. So let me end our presentation with next week is our upcoming earnings. So we will have it for the next 3 or 4 weeks. The main ones I've mentioned before, the big earnings usually happen, especially if they're good, happens the first 2 weeks. After the second week, the third week, it gradually kind of grinds down. So the big names, you're going to have it the next week and the following week, and you're going to have the Amazons and Apples of the world and Google. So these are the big ones to start. Like Monday, we have Pepsi, and then this is important, the banking. We're interested to see what's going to happen with JPM and Citigroup. IBM used to be a big one in the 80s, and I always look forward to it. And, the United Healthcare is an important part, actually. By the way, it's one of my 13-year-old son has a portfolio of 5 stocks, and UNH is one of them. Amazon, Netflix, and I think it's I2 or Take-Two, and Walmart. So those are his holdings. Johnson & Johnson is coming on Thursday, and obviously everybody's looking forward to see what Netflix is going to do. And Friday, we'll see what BlackRock is doing. So with that in mind, I think this was our analysis for the previous week. And again, you want to make sure you are make sure you stay nimble. Don't fight the market, but just know, got to be on your toes. You can't just blindly investing in. I think the times of buy and hold I've mentioned before. It's more of a nimble times for the decade. Not I keep repeating this. Not for 6 months or a year. If you're in the right stocks, you've done fantastic. If you had QQQ, you've done fantastic. If you had Russell 2000, if you had the financial, if you had JP Morgan, if you had the Wells Fargo's, if you had Norwegian Cruise Line and Wynn and a lot of other hotels, there's problems. So that's about it. Next week, as I mentioned, we will have our subscription plan is going to start. Again, my goal, my mission is, as I mentioned, our next generation is my goal. If I could have a generation of teenagers who are confident and they know they can actually be a real person, independent, not only financially, but emotionally and mentally, that will be wonderful. And I really love sports, so I'm trying to use the sports to help with that. The education, I'm trying to bring not just the money management side of things, but the investment side of things. If you can do that, and having you behind me, that would my dream to come true. So this is all about education. It's all about having the right tools that you can have access to. As you know, I love books. I read all my life. It's been my passion reading books, but sometimes the books, it can be very book smart, but when it comes to life, unfortunately, it doesn't translate to that. So my goal is hopefully I can approach this to give you the right tools and in a diverse way to show you what is happening, how all the pieces come together. It's not just about, okay, let's do income strategies using options, single dimension. Let's do Forex, single. I'm hoping for you to become so independent that you start actually teaching your members of family or your friends independent. In the meantime, hopefully make money and be successful. But again, making money shouldn't be your prime goal. Learning the tools, the process, and the money will come with it. But also that doesn't mean that ignoring that. I mean, at the end of the day, it's a business. You want to make sure you become profitable, but don't be impatient. That's the other reason I want to start it. Please be patient. Our services will start next week, and as I mentioned, it's besides our weekly, we will have other, instruments and videos that hopefully will help you to maybe speed up your growth. At the end of the day, I will offer whatever I know. And I mentioned before, if we have 100 millionaires around the world, it doesn't take money away from anyone else. If the more you know and the more money you make and the more independent you are, it's the most wonderful thing. And if I could play just a tiny little bit role in that, that will make my day. So anyway, I very much appreciate your patience, your attention, and being part of our family. And I hope we continue our journey. So with that in mind, Sean, I'm at your service right now. We can open for questions, and maybe if you want to, Sean, we can even stop recording if you think we can just do that. Sure. And so it might be a little easier for the question and answer. Okay. So it can be pretty open, so it won't be public.
Yep.
All right.